Let's dive deeper into the action right now with all of our markets reporters from equities, bonds, currencies to commodities. Abigail, get us started.
Romaine, with such small moves for stocks, I want to highlight a chart that was brought to us last week by Frank Capillari at Instant. It's one of the better charts I've seen in a while, and it is small cap. And historically, small cap does very well in December. This chart makes a compelling case for small cap to probably do well in December, maybe into 2020 if the bullish mood remains in place. What we're looking at is a decade-long chart of IWM, the small cap ETF on top, and then we have IWM relative to the SPY or S&P 500 on bottom. And we see over this last decade, small cap has really been underperforming, but it's doing so in an orderly way in this trend channel. So you can see these bottoming areas. That's when small cap has started to outperform. Well, lo and behold, right now, Taylor, we're in one such area. Frank Capillari is very bullish on the fact that small cap is not only broken out above that 1600 level and has held, but it does appear that we could be in position for a time of outperformance relative to large cap. He likes both for 2020, but he really likes small cap, Taylor.
Well, Abigail, I'm going to combine here bonds and technology and see if we can do both in 30 seconds. I'm taking a look at Twitter today, which is issuing their first junk bonds, about $600 million coming with a yield of, we're hearing on 8-year notes, about 3 3/4. They're getting interest, though, of about $6 billion. So to put that into perspective, it is the lowest amount for securities maturing in 8 years or more within the high yield bond market space since at least 2014. So shares, of course, rising there as bond pricing looks like it is going to do well. And it's good that Twitter is in the double B range because, as you can see there, double B has really performed the single B space and the rest of the high yield market, which has only performed about 12% or so. That double B spot really has been the outperformer as it's the closest rated up to investment grade as investors get a little bit defensive. And so they're hitting right in that sweet spot. Sarah?
Taylor, well, over the past couple of weeks for equities and bonds, small moves have really been the name of the game. That was until this week. We had seen 37 straight days where we hadn't seen an intraday decline for the S&P 500 of more than 1%. Then earlier this week, we had 2 days in a row. Well, today, we are back to relatively minimal moves once again. You have stocks higher, although very modestly, only 15 basis points for the S&P 500. You look at bonds, though, you're looking at TLT, that's the iShares 20-plus year Treasury bond ETF, down roughly 0.5 percentage point as we do see yields gain. However, all year long, we've actually seen stocks and bonds performing well in tandem. This has been discussed many times before. But what you're looking at here is the combined total return of the S&P 500 and a Bloomberg Barclays index that tracks treasuries. And what you can see is that year to date, we have a return of roughly 19%. Well, that is the best year for the 60-40 portfolio since all the way back in 1998.